ExamPrep.School. Indiana Life and Health Insurance Laws and Regulations exam. There are 5 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Health regulations. Indiana laws and department rules common to all lines. Life regulations. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under Indiana law, which of the following best describes a primary duty of the Commissioner of Insurance? A. Conducting continuing education audits of individual producers. B. Regulating insurers to ensure their financial solvency and compliance with insurance statutes. C. Establishing uniform premium rates for life and health insurance policies. D. Providing binding arbitration services in insurance claim disputes. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. This option is correct because the Commissioner's core responsibility under Indiana Code is to supervise and regulate insurers, ensuring their financial solvency and enforcing compliance with insurance laws. Reason A is not correct. Regulatory oversight of continuing education is performed through rulemaking and producers' self-reporting, not by direct audits by the Commissioner. Reason C is not correct. Rate setting is generally handled through rate filings and actuarial review, not direct establishment of uniform premium rates by the Commissioner. Reason D is not correct. Arbitration services for claims are provided by private entities or through specific statutory procedures, not as a duty of the Commissioner. Question 2. According to Indiana statutes, the Department of Insurance may examine an insurer's books and records at which of the following intervals or under which circumstances? A. Solely upon receipt of a favorable financial rating from a national agency. B. Only after a formal policyholder complaint triggers an inquiry. C. Once every 10 years regardless of the insurer's financial condition. D. At least once every 5 years and more frequently if warranted by the department. The correct answer is D. This option is correct because Indiana Code requires a financial examination at least once every 5 years and authorizes more frequent exams when conditions or reports indicate potential concerns. Reason A is not correct. A favorable rating does not trigger an examination. Exams are risk and schedule-based. Reason B is not correct. Examinations are not limited to complaint investigations. Statutory schedule and risk triggers also apply. Reason C is not correct. The 10-year interval is incorrect, as the code specifies a 5-year schedule. Question 3. What is the primary purpose of a market conduct examination conducted by the Indiana Department of Insurance? A. To assess an insurer's financial solvency through detailed asset and liability analysis. B. To evaluate compliance with statutes governing sales practices, advertising, underwriting, and claims handling. C. To establish actuarial soundness of premium rates proposed by insurers. D. To audit producer licensees' continuing education compliance. The correct answer is B. This option is correct because market conduct examinations focus on an insurer's adherence to consumer protection statutes in sales, marketing, underwriting, and claims processes, not financial condition analysis. Reason A is not correct. Assessing solvency through financial analysis is the objective of financial examinations, not market conduct exams. Reason C is not correct. Reviewing premium rate soundness is part of financial or actuarial reviews, not market conduct investigations. Question 7. Under GS 58-71-1, which entity is defined as a surety bail bondsman? Question 4. Under Indiana law, which of the following events can trigger a financial examination of an insurer outside the regular 5-year cycle? A. Consumer complaints falling below a statutory threshold. B. The insurer filing its audited financial statements on time. C. A material change in the insurer's management or ownership structure. D. Receipt of a favorable financial rating from a national agency. The correct answer is C. This option is correct because Indiana statutes authorize unscheduled financial exams when there is a material change in control or management of an insurer. Reason A is not correct. Low complaint levels do not prompt exams. High levels might signal issues. Reason B is not correct. Timely filing of audited statements does not trigger an examination. Delayed or missing filings may. Reason D is not correct. A favorable financial rating does not trigger an exam. Adverse ratings or risk indicators do. Question 5. An Indiana insurer missed the deadline to file its quarterly financial report with the Indiana Department of Insurance. What action is the department most likely to take as a direct consequence of this reporting failure? A. Impose a civil penalty up to $5,000 for each late report. B. Conduct a market conduct examination at the insurer's expense. C. Suspend the insurer's certificate of authority until the report is filed. D. Restrict issuance of new policies until remedial actions are completed. The correct answer is C. This option is correct because Indiana law grants the department authority to suspend an insurer's certificate of authority when required reports are not filed timely, ensuring compliance. Reason A is not correct. Civil penalty amounts are prescribed per day and are not the primary enforcement for missed filings compared to suspension. Reason B is not correct. A market conduct examination is a broader regulatory tool, not the immediate statutory sanction for late financial reports. Reason D is not correct. Restricting new policy issuance is reserved for insurers in hazardous financial condition, not solely for missed report filings. Question 6. According to Indiana law, which of the following is not a requirement for obtaining a resident insurance producer license? A. File a surety bond with the department. B. Submit fingerprints for a background check. C. Be at least 18 years old. D. Demonstrate good moral character and financial stability. The correct answer is A. The correct answer is that filing a surety bond is not mandated for individual producer license applicants. The other items are statutory prerequisites. Reason B is not correct. Fingerprint submission is required for comprehensive background screening. Reason C is not correct. Applicants must be at least 18 years old under state licensing requirements. Reason D is not correct. Demonstrating good moral character and financial stability is a statutory requirement. Question 7. Under Indiana's producer licensing reciprocity provisions, a non-resident insurance producer may apply for a non-resident license if the applicant A. Hold a valid home state producer license. B. Maintain a principal place of business in Indiana. C. Reside in Indiana for 6 months. D. Successfully pass a separate Indiana licensing examination. The correct answer is A. The correct answer is that non-residents from reciprocal states need only possess an active producer license in their home state. Other conditions are not required under reciprocity. Reason B is not correct. A physical Indiana business location is not required for non-resident reciprocity. Reason C is not correct. Length of residency in Indiana is irrelevant for non-resident applicants. Reason D is not correct. Reciprocity waives additional Indiana-specific examination requirements. Question 8. Which of the following is required for a business entity to obtain an insurance producer license in Indiana? A. Have majority ownership interest held by licensed producers. B. Designate at least one licensed producer within the entity. C. Submit audited financial statements to the insurance department annually. D. Maintain a dedicated physical office facility in Indiana. The correct answer is B. The correct answer is that a licensed business entity must designate a licensed individual as its responsible producer. The other listed provisions are not mandated by Indiana licensing statutes. Reason A is not correct. Ownership by licensed producers is not a statutory requirement for entity licensure. Reason C is not correct. Annual audited financial statements are not required for producer licensing. Reason D is not correct. No physical office facility in Indiana is mandated under licensing rules. Question 9. When applying for an Indiana insurance producer license, an individual who intends to sell variable annuities and life insurance must select which line of authority? A. Life. B. Casualty. C. Health. D. Property. The correct answer is A. The correct answer is that the sale of variable annuities and life insurance contracts falls under the life line of authority. The other lines cover unrelated insurance classes. Reason B is not correct. Casualty authority covers liability risks, not life products. Reason C is not correct. Health authority applies to sickness and medical plans, not annuities. Reason D is not correct. Property authority addresses property risks, not life insurance. Question 10. On an application for an Indiana insurance producer license, an applicant is required to disclose which of the following? A. Any speeding violation within the past 5 years. B. Federal civil judgments arising from contract disputes. C. Any felony conviction in any jurisdiction. D. Bankruptcy discharge more than 7 years ago. The correct answer is C. The correct answer is that felony convictions must be disclosed on the application. The other listed items are not disclosure requirements under Indiana insurance law. Reason A is not correct. Minor traffic violations are not part of required disclosures. Reason B is not correct. Civil judgments for contract disputes are not required disclosures. Reason D is not correct. Old bankruptcy discharges beyond statutory look-back periods need not be disclosed. Question 11. An Indiana applicant for a producer license submits fingerprints to the Department of Insurance as part of the licensing process. In a scenario where the department reviews these fingerprints, what is the primary purpose of this requirement? A. To document existing affiliations with authorized insurance companies in Indiana. B. To verify that the applicant has submitted all required licensing fees to the department. C. To confirm that the applicant has completed all mandated pre-licensing education courses. D. To obtain the applicant's criminal background history and assess suitability for licensure. The correct answer is D. The correct answer is to obtain criminal background history because fingerprint-based checks are used by the department to identify disqualifying offenses and ensure applicant integrity before granting a producer license. Reason A is not correct. Professional affiliations are recorded via appointment filings, not through criminal background reviews when licensing. Reason B is not correct. Fingerprinting does not serve to confirm fee payment, which is verified through administrative records rather than background checks. Reason C is not correct. Completion of pre-licensing education is documented through course transcripts and certificates, not fingerprint analysis. Question 12. When an Indiana licensed producer dies unexpectedly, the surviving spouse may request a temporary producer license. In this scenario, which statement best describes the purpose and typical duration of a temporary license under Indiana law? A. It enables the spouse to transfer appointments to another producer before policyholders are notified, valid for 120 days. B. It permits the spouse to solicit and bind new business under the deceased's agency for up to 90 days. C. It allows the spouse to continue servicing existing policies for a limited period, typically up to 180 days. D. It grants the spouse full producer authority to operate the agency indefinitely until the permanent license is issued. The correct answer is C. The correct answer is that a temporary license allows the surviving spouse to service existing policies for up to 180 days, ensuring policy continuity after a producer's death without granting indefinite or full new business authority. Reason A is not correct. Appointment transfers are handled through carrier filings rather than via a temporary license issued for policy servicing. Reason B is not correct. Temporary licenses do not permit solicitation of new business, which would exceed the limited scope intended by statute. Reason D is not correct. Temporary licenses are time-limited and do not grant indefinite authority pending permanent licensure. Question 13. Under Indiana insurance law, which action best illustrates misrepresentation of policy terms by an insurer? A. Advertising that a homeowner policy covers flood damage when flood perils are explicitly excluded. B. Omitting mention of the 3-day free look period in the policy summary. C. Describing non-participating life policies as eligible for future dividends. D. Permitting a staff member to waive the application fee for a group purchase. The correct answer is A. Misrepresentation occurs when an insurer states or implies coverage that the policy expressly excludes. Advertising flood coverage under a policy that excludes flood is a direct misstatement of policy terms. Reason B is not correct. Failing to mention the free look period is non-disclosure rather than an affirmative misstatement of coverage. Reason C is not correct. Describing dividends for non-participating policies is inaccurate, but relates to policy type features, not misrepresenting specific coverage terms. Reason D is not correct. Waiving an application fee is an inducement issue, not a misrepresentation of what is covered under the policy. Question 14. Which statement most accurately defines twisting under Indiana insurance law? A. Inducing a policy owner to replace an existing policy with a new one, showing inferior benefits by making false comparisons. B. Using deceptive illustrations to show higher dividends in a participating policy. C. Withholding claim forms to prevent timely loss reporting. D. Offering scaled commissions on the basis of agent productivity. The correct answer is A. Twisting involves persuading an insured to drop an existing policy in favor of a new one that is not to the policy owner's advantage by using misrepresentations or comparisons. Reason B is not correct. Deceptive dividend illustrations relate to misrepresentation, but not the specific practice of replacing policies to the insured's detriment. Reason C is not correct. Withholding claim forms is a claim handling violation, not twisting. Reason D is not correct. Adjusting commissions is a compensation issue and unrelated to policy replacement misrepresentations. Question 15. Under Indiana insurance regulations, which of the following inducements is a permissible exception to the rebating prohibition? A. Providing dividends declared under the policy's terms to participating policyholders. B. Offering free tickets to a charity event to those who submit applications. C. Extending a premium credit to close relatives of the insured. D. Waiving the initial application fee for any referral. The correct answer is A. Dividends that are contractually promised in participating policies are not considered rebates. They are a return of excess premium provided under the policy terms. Reason B is not correct. Free event tickets are a non-contractual inducement and violate rebating provisions. Reason C is not correct. Offering premium credits to relatives is a prohibited inducement regardless of relationship. Reason D is not correct. Waiving application fees for referrals is a rebate since it's not specified in the policy contract. Question 16. Which example constitutes defamation of an insurer under Indiana insurance statutes? A. Publicly alleging without proof that an insurer is insolvent to discourage policy purchases. B. Misquoting premium rates in advertising materials. C. Failing to include all available discounts in a policy summary. D. Delaying payment of claims beyond statutory time limits. The correct answer is A. Defamation involves false statements about an insurer's financial condition or business made with reckless disregard for truth, such as alleging insolvency without evidence. Reason B is not correct. Misquoting rates is a misrepresentation offense, not defamation of the insurer. Reason C is not correct. Omission of discounts relates to non-disclosure or misrepresentation, not defamation. Reason D is not correct. Delaying claim payments is an unfair claim handling practice, not defamation. Question 17. An Indiana licensed agent distributes a brochure stating, "This policy is approved by the Indiana Department of Insurance," and touts projected dividends without indicating they are not guaranteed. The brochure lists the insurer's trade name but omits the full legal name and fails to include the agent's license number. Which aspect of this brochure violates Indiana's false or misleading advertising standards most directly? A. The failure to include the agent's license number. B. The absence of a disclaimer that dividends are not guaranteed. C. The omission of the insurer's full legal name. D. The claim that the policy is approved by the Indiana Department of Insurance. The correct answer is D. Indiana law prohibits implying endorsement or approval by the Department of Insurance. Stating the policy is DOI approved is a direct misrepresentation. Reason A is not correct. Not including the agent's license number breaches identification requirements, but does not constitute misrepresentation of endorsement. Reason B is not correct. While omitting a disclaimer about non-guaranteed dividends is misleading, it is secondary to falsely implying state endorsement. Reason C is not correct. Failing to use the insurer's full legal name violates identification rules but is not a core false endorsement issue. Question 18. Under Indiana's unfair claims, settlement practices regulations, within how many working days must an insurer acknowledge receipt of a written notice of claim, correspondence, or proof of loss? A. 5 working days. B. 10 working days. C. 15 working days. D. 20 working days. The correct answer is C. This option is correct because Indiana law requires insurers to acknowledge receipt of claim-related communications within 15 working days under the Unfair Claims Settlement Practices regulations. Reason A is not correct. That time frame is too short. Indiana law specifies a longer period for acknowledgement. Reason B is not correct. Indiana law requires more working days before acknowledgement than this option allows. Reason D is not correct. Indiana law requires acknowledgement sooner than 20 working days. Question 19. According to Indiana regulations governing unfair claims settlement practices, what is required to satisfy the mandate for insurers to adopt reasonable standards for claim investigations? A. Perform a complete investigation and issue acceptance or denial within 30 calendar days of receiving proof of loss. B. Establish and implement written guidelines detailing procedures and documentation requirements for claims investigations. C. Resolve all disputed claims through arbitration within 60 days of loss notification. D. Base all claim decisions solely on documentation provided by the insured without additional inquiry. The correct answer is B. This option is correct because Indiana regulations require insurers to have documented procedures and standards that outline how claims investigations should be conducted. Reason A is not correct. Issuing a decision within 30 days is not the regulatory requirement for investigation standards. Reason C is not correct. Mandatory arbitration timelines are unrelated to the standards for claims investigations. Reason D is not correct. Investigations must include independent inquiry beyond insured-provided documentation under Indiana law. Question 20. A homeowner submits a claim for mold damage under her Indiana HO3 policy. During the claim review, the insurer's claims adjuster tells the homeowner that mold remediation is specifically excluded in her policy, despite the policy actually providing up to $10,000 in coverage for mold damage. Under Indiana law, which of the following best describes this adjuster's conduct? A. Failing to affirm or deny coverage within 15 business days after receiving a proof of loss statement. B. Misrepresenting pertinent policy provisions regarding coverage for mold remediation. C. Requesting an unnecessary examination under oath to delay claim payment. D. Neglecting to promptly and thoroughly investigate all relevant aspects of the mold damage claim. The correct answer is B. The correct answer is misrepresenting pertinent policy provisions. Indiana law prohibits an insurer or its adjuster from knowingly misrepresenting policy terms or coverages to an insured during claim handling. Reason A is not correct. Failing to affirm or deny coverage within 15 business days is a separate late response violation, not a misrepresentation of policy terms. Reason C is not correct. Requesting an unnecessary examination under oath may be unfair but differs from knowingly misstating coverage provisions. Reason D is not correct. A delayed or inadequate investigation is a distinct unfair practice, not a direct misrepresentation of policy language. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.